Hey guys, so we're back with another video for FAR 1. This time we're doing lower of cost or net realizable value, and then also lower of cost or market. This one is LCNRV as I abbreviate here. This one's LCM. That's what I'm most likely going to refer to them as, just for the short term because they're kind of long. This LCNRV has come about relatively recently. The LCM was the one that I did when I came through the class about 3 or so years ago. And then this one has been added within the last year or so to GAP. And so this is covered on Chapter 9, pages 444 through 452. The LCNRV is the most inventory methods use LCNRV. They're required to use LCNRV versus LCM. Only the LIFO, the dollar value LIFO I should have in there. I think it's all types of LIFO can use LCM, I believe. Yeah, right. So, sorry. Yeah, right. So I had it right the first time. All types of LIFO and then retail inventory method are allowed to use LCM. Only any other inventory method you have to use LCNRV. Sorry about that, but that's how it works. Anyways, so how's this work? We're just going to go ahead and walk through these two different methods, and then most likely in a separate video, I'm going to talk about one major stumbling block when we talk about these type of inventory methods. Basically a big overview before we get into the two types of methods. The whole point of this is that this is based off of a principle called conservatism. I'm sure you've heard of this in accounting. We are worried that our assets will be overvalued, and so we would much rather understate assets than overstate assets. And so in the interest of doing that, these methods have arisen through practice. And so you'll see why it's conservative, because you can see it in the name, right? Saying you're going to state at the lower of cost or the net realizable value, right? So whichever one's lower, we're going to state our assets at, right? And so that would be a conservative approach because you're stating your assets at the lowest possible amount that seems reasonable, right? We don't want to overstate the assets. Okay. So LCNRV, the basic thing is we want to choose between the lower of cost of the inventory or the NRV. The cost of the inventory is what we paid. Okay, and then the NRV is defined as the estimated sales price minus the cost to sell the inventory, and that's basically what we do. This one's actually the easier of the two. So basically, what you're generally going to do is you're going to be told the cost, and then you would either just be straight up told NRV, net realizable value, or the book would tell you these two pieces of information, so estimated selling price and then cost to dispose of the inventory or finish it or whatever the cost to sell are. But anyways, in this example, we say, okay, cost is 60, NRV is 50. Well, which one's lower? 50. Okay, so on our books, we would want to state our inventory at $50. Okay, the journal entries to do that, we're going to cover in the next video, and so just look for that. But I just want to get the intuition down now of how to do this, and then we're going to work on the journal entries because they can be a little tricky. That was example 1. Example 2 is a little more difficult. This is where you have to make sure that you're awake. Right, so they tell you cost is 40, but NRV is 50. So a lot of times people just go ahead and pick 50, but again, it's lower of the two, right? And so the lower of the two is actually the cost, it's 40, right? So we're not going to write up our inventory. We don't do that under GAAP. You can do it under IFRS in certain situations, but not under GAAP. Okay, you can't write your inventory up above its costs. You can have recovery of losses, and we'll cover that in the second video, but we can never just say, let's write our inventory up above the initial cost of what we paid. All right. Now let's look at the second side of this, which is the lower cost or market LCM. Again, can be used for any type of LIFO or retail inventory methods. The basic approach here is to choose the number that is the lower of the cost or the market. And I have market in little quotes. What does that mean? It means the market is the designated market value, and it's the middle value of these three. So 1, 2, 3. The net realizable value, the replacement cost, or the NRV minus a normal profit margin. So what you'll do is that first you have your cost, right? We always have our cost. We have an inventoriable cost that we paid. And then between these three numbers right here, we pick the middle one, right? So if NRV was like, well, actually, we'll do an example in a minute. We'll see, but we just picked the middle one. All right, so let's do that so we can kind of see how that would work. All right. Example, the cost is $30 of the inventory, and then we're given our three numbers. So again, you can you might have to solve for these. They might be given, but if you did have to solve, they're relatively straightforward, right? It's NRV, replacement cost, and then NRV minus normal profit margin. They're relatively simple to solve for, as long as you kind of know what the definitions are and what the formulas are. So NRV we see here is 40, replacement cost is 50, and NRV minus the normal profit margin is 35. So which one is in the middle? It would be 35, right? So that means our market value is 35. Okay, so then we want to figure out what we're going to have on the books. Okay, cost on the books. Okay, we're comparing cost to the market value, and we're picking the lower one, right? So the lower one would be 30. So the cost that we would have on our books would be $30. Okay, that's going to conclude this video. In the next video, we're going to go through a couple examples, or at least one example, or maybe two examples of the difference between the loss and the cost of goods sold methods, and then also going through the allowance method, when we use that versus when we just use, when we write down the inventory directly to the inventory account. So look for that video, and see you guys then.